Good evening, everybody, and welcome to our webinars where we will talk about gold, the shining allure of gold, myths, cliché, and different insights. So first of all, always remember that nothing we're gonna say is investment advice. It's just some color that we wanna give to you. We'll share some knowledge, but you must make your own analysis and take your own decision. So let's go. Why we decided to speak about gold? Okay, before starting, I will explain a little bit how this is done, this webinar. We will be speaking more about fundamentals, things economical, a more macroeconomic perspective during the first 10-15 minutes, and then move finally to a chart, and probably that's what is more interesting for you, and analyze the price action. Why we do this? Because we think that for every instrument, you have to know a little bit about it before starting, have an idea, a long, mid-term strategy before going into it and start trading. So we choose gold. Why? Because it has been one of the most popular and interesting instruments during this year. It has absolutely been under the spotlight. It has had wonderful returns. It has one of the best performing assets till a few weeks ago. The top up of the previous all-time highs. It's also a very stable instrument and has delivered consistent performance throughout the years. We will just show you soon. As you can see from here clearly, some very good returns. There has been our instruments that had better returns, but with a much bigger drawdown. What is the drawdown? The fall since the maximum. You don't want to be into an instrument that, okay, I'm gaining 4%, but before it was down 50%. Maybe you already choose to close your position before you're forced to close it. So it's good to have to be in a stable instrument, and investors do things this way. You can see very fast. The red line is the gold. You can see how its performance has been constant, while other instruments, DAX, the SP 300, not to say the oil, well below the gold performance and have dropped for dramatically more than gold. We were saying it has had fantastic performance during years. That's why investors really like it. This is the performance. These are performance of gold during the 21st century against several different currencies. You can see the picture is almost entirely green. Only between 2013 and 2015, it has not delivered. And the average during 20 years has been of an increase, a yearly increase of around 10%. That's a really good, fantastic long-term performance. It's similar, if not better, to stocks, to equity, but with much more stability, while stocks are more volatile, more risky. But all of these reasons are the one that makes gold an interesting instrument for retail and professional investors. So you've noticed probably that the title is Gold's Myths and Cliché. Why we title it this way? Because generally there's some common explanation. We want to check them out. Two of the main reasons that are used for explain the gold performance is that first, it's an hedge against bad market performance. Things are going bad in the economy, people buy gold. The second one is that gold is an hedge against inflation, the devaluation of the currency. Prices are going up, currency is losing value, real value, people buy gold. Are these things confirmed by reality, by facts? Here we have a chart from the Federal Reserve database. SP 500 in blue, gold in red, orange, whatever. You can see, we can clearly see there's also visualizing it is not a proper inverse correlation. These data are from 2010. There has been years where there has been an inverse correlation, but recently, in the last 2 years, market is going up and gold is going up. So it really doesn't look that people flow into gold when things are going better in the market. Okay, this is some more statistical thing. I won't bore you too much. This is the correlation, actually. We calculated mathematically. You can see the in different time frame, 1970s, 2000, it always has been positive, stronger or weaker, always positive. That means that on a long term, SP 500, equity markets, and gold moves the same direction. It's not true at all that they move in different direction. This one is the rolling correlation, just to let you know that things change continuously, but we cannot absolutely see an inverse correlation. So the second common thing that people talk about is that gold is an hedge against inflation. Inflation goes up, gold goes up. Okay, in blue, once again from the Federal Reserve database, in blue we can see inflation from 1980s, in red, gold. The inflation rate has been going down continuously from the 80s. It was at 30% to 1.3% in August 2020. This is US, while the gold was going up. For on overthrow, inflation is a return. We can use consumer price index as a cumulative way of inflation. It's true it has been increasing, but the velocity of its increase has been slowing. You can see it during last years, while gold was booming during last years. So maybe there's some kind of relation between inflation and gold, but not that one that is normally used as an explanation. All right, here we just focus on more short-term inflation in Europe going negative, or in the US even going lower, but you know that gold has exploded. Here it is, last year's. All right, so here we're gonna explain a little bit who are big investors, the ones who move the money, and what they're looking for. People like institutions like pension funds, insurance or funds, but people who manage your pension, the money of the state, the money you put in insurance. These people, this institution, first of all, they have very strict regulatory limits. They cannot invest in anything. They probably won't invest in Tesla. Recently has not been accepted in the SP 500. It's just an index, but they have a strict regulation. What they're looking for are stable returns on the long term. They're looking for returns. They do not speculate. They're looking for an income. What is an income? Like you have a house and you're getting rent from it. You are investing in bonds, fixed income. You're getting a coupon, or you're investing in stocks because you want a dividend, not because you are looking for a difference in price. This is what big investors are doing. Gold for himself is not really yielding nothing. Actually, it has a cost for real investors: transportation, storage, safety, security. This is in a normal situation. But in a normal situation, coupon, bonds, stocks yield something. We are living in a zero interest rates world. The bond market is the biggest market for investors. All official interest rates are zero or negative, and government bonds are absolutely negative. That means you're putting money there, hoping for a safe return, and you're eroding your money, you're losing money. You can see that 10-year US is still positive, but if you add that famous inflation, the real rates curve, it's completely negative in US as well. You put money, once again, in the biggest investment market for institutional investors, and you are losing money. Okay, the concept of real rates, nominal interest rates, less inflation. This is a little bit technical. I hope you are following me, and we are getting to the point after this short presentation. Okay, also stocks, but it's not the biggest investment market for institutions, have a very low dividend yield. Okay. Finally, it's not easy for big guys to get an easy income. But what happens? What happens? When the traditional sources of investment goes negative, real rates goes negative, you don't have any more that cost of hoarding on gold. You don't have any more gold don't yield you anything, but it's stable. It had appreciation during the years, and you're not losing money. So you can be confident about it. Here you can see the real rates in blue and the gold in orange. Here you can see a very clear correlation. When real rates go down, like it's happening right now, gold goes up. The previous high in gold has been in 2012, 2011, 2012, 2013, and it was when real rates in the United States was at -1%, when they started going up and going down. And now, once again, we are at -1%, the all-time minimum for real rates. Okay, so our thesis is that on the long term, there's really a correlation, a serious correlation among the real rates that have something to see with inflation and the price in gold. So to have a look also on real rates, what you can do, you can, this is quite technical. I won't bore you too much, but you can have a look to the yields on the bonds of the biggest market, the US. You can check it out in CNBC, Bloomberg, whatever. You can follow the data on inflation, plenty of sites, websites like the Trading on Economics. It's plenty of wonderful macroeconomic data that you can have a look at. And of course, finally, you can use technical analysis for finding entry points consequentially. Here you can see how you could see the 10-year yield on the US bonds. You can use technical analysis in this also for confirming. Here's a page from Trading Economics. You see all the inflation, a lot of stuff that is useful. Also, moreover, gold. Okay. Here we're giving you also a tip. There's an instrument called the Treasury Inflation Protected Securities. Basically, this track the real rates. I stamped this screen share few days ago. It was at -0.92%. So we have seen that real rates are now at historical lows, and that historical lows was in 2012 when gold has stamped the previous high. So before moving to the charts, that will be easier, more interesting probably, what could happen? We have seen the relation between real rates and inflation. Central banks are still looking for, have been looking for increasing inflation for years, but they have been unsuccessful for years. And even if inflation starts to rise, bonds react faster. That means going up faster. As already stated, we think that real rates, they have been fighting a floor, at least in the midterm. And once again, we are now at those levels that have been the minimum and that have meant the previous maximum in gold. So finally, to get to a final mid-long-term perspective before entering in pure trading, we think that the mid-term upside is capped at the moment. We are close to a historically high levels. On the longer term, if low growth, low interest rates persist, it will be supportive for gold. But me personally, I don't expect new highs in next few months. Better expect a consolidation at least. Okay. All right. Here, before moving to charts, a very fast thing. Many of you probably have noticed the relationship with among gold, dollar going down, gold moving up. Correlation is very high. Once again, we calculated it. This is the rolling correlation. This correlation exists, but I'm sorry about that. But it continuously move, and what I wanted to say about it that even if this year the correlation has been very high, don't give it don't think that this is a magic formula. This will change at some point. Maybe not very soon, but it will change. It's good to look to the dollar as an indication, but if such a strong inverse correlation has not always been that strong. All right. So before moving to chart, I will also give you probably already know as a client of ours all, about our statuses. This is for telling you that we have presented previously this webinar to a sample of our VIP Plus clients. This event decided to make it open to everybody. In the future, in the near mid future, this kind of material, more analytic stuff, will be available for VIP Plus clients, besides of all of the other discounts and advantages. Also, all the Telegram channel will be available for VIP people. So there's a lot of work behind it. So for now, just let's enjoy this webinar all together. So we will move to the charts now. Just to summarize, the idea is have a look at real interest rates that are nominal rates minus inflation. They mean that investor cannot find earnings, cannot find a yield somewhere else, and gold becomes incredibly luring in the moment. But if rates goes up, it's less luring. It's still stable. It's still something that has been a very good performer, but it stopped to be such a wow, an incredible asset in the long term. Okay, let's move to the chart. Okay, the full screen. I totally cleaned up my chart. Okay, what I think is very important, just to show you the process as well, but I think it's important to maintain. The first step is to have, once again, a long-term view where we are. Here is very long-term, from 2011-12 till now. So we are just above the previous all-time highs. They were here, 1,900. So just keep it in mind. We see the trend that started in late 2018, a very strong trend. Just keep in mind, we are very close to the previous all-time highs, and this could be also a support, a resistance, whatever. Let's switch to something that is more short-term. So let's have a look of several ideas of trend lines. Okay, let's start when currency was still flat, but we can imagine a trend line. It's not of our interest, but just to have it here. In 2018, we've seen that the trend started to really burn. So what we'll do is to identify this. This will be the last step, steep trend. We're just not very interested in rumor. Rumor can happen. Price can go up or down trend line for some days. But we'll try to fit it on what happened on the long term. Okay, and so we keep on thinking about. Okay, it's okay. No problem. We keep on thinking which are the kind of trend lines that happened, that have sustained price during the last years. Okay. And we will try to analyze, to understand which are the more recent one, and so which are the first that will be interesting for us. Okay. Right. So let's start exactly from the more recent. The more recent has been this one. Okay, price has been go up very fast after the COVID crisis. This is March. This is February, March. You can see it. gold has started recovering before anybody else has go up almost vertical. What we can see here, it has been broken. The steepest one has been broken. So it's not anymore going up fast. Still, there's several other trend lines. I'm doing this live. It would have been easier to have it already done, but I wanted you to see the whole process. All right. We're saying the steepest one has been broken, but the overall trend is still clearly on the long term, clearly to the upside. Whenever the price will hit here, or even here, or even here, we're not thinking it's going to happen soon, but nothing will be change in the long term. The steepest one is broken. Let's start being more accurate and more tied to the short term. No, not even to the very short term, because from here to here, this is August. This is the high in August. Here we are already in October. So what we can see, we can once again find some trend lines, and we can find a figure that is a triangle. All right. Here we have a trend line. This, we consider it at this point just rumor. Just a one-day very up candle, immediately rejected. Here you can see even a kind of, it's not a doji, it's not a shooting star, but an indecisive candle. Okay. So we start from here. And we draw this, this downtrend. Okay. What else? What else? We will draw other strands here. First one, because okay, I know it, how it was before. We'll draw this one. Before the situation where we are now, we had this, the price till here, till mid-September, the price was into this triangle. You can see that every time that gold was coming down to 1915, 1920, rebounded to the upside. What happened on September 24th, this previous triangle has been broken. And the moment it has been broken, bam, it accelerated to the downside. It accelerated to the downside. Okay, here we are. But what we had here was the previous low set after the first drop. And the price rebounded here. It found the resistance, support. So it rebounded, and it's going up right now. Okay, so in the very short term, we are here. Let's do another thing. Not the Bollinger Bands. Let's show the moving average. I place here some moving average. These are the 50 and the 100 moving average, so it's something for the long term. You see that the price is in the middle. You see that while we had an uptrend, a clear uptrend, the price was above, most of the time above both the moving average. Now it's in the middle. We're in an decisive moment with a downtrend coming, the price not going below the very important 100 simple moving average. And here we are. Here is where we are now. We're in the middle of the Bollinger Bands. We don't get any clear signal from Bollinger Bands here. Bollinger Bands are an indicator that help you with volatility. So just put it out. RSI and MACD, what we can see, if I'm able, what we can see, RSI is going clearly down. It's going much more down than the price. MACD is below zero. It has crossed once again during this day to the upside. It's not bad news, but it's below zero. And below zero is not a very good sign. So finally, having in mind also the overall idea, what we're looking here, we are looking for a consolidation. The levels that we are clearly looking to the downside, if it will happen, we must be very careful from 1900 where we now to 1860 to 1860. 1860 and okay 1850. Support and resistance are always area. If this is broken, price will keep on going down. Will keep on going down, and a first target that will make sense is this area, 70-80, where we also see some previous stop in the prices. Okay. I won't go any further than this. I told you that I think that we think that there will be some consolidation, so no potential upside, but let's not go that far away. Let's see if this level is broken. Here we could find the first resistance, a support that would help us rebound. But if this one is clearly broken, probably we will go down to these levels, and there will be no problem for no serious breakup in the uptrend, even if we will see the price trading up to 1650. 1650, it will be still bullish. On the other side, a break to the upside of this red line will be bullish, will be mid-term bullish. If the price is able to close clearly above this, we will go to 1970, very probably, and eventually up to 2000 once again. Why not? And this will be once again a big resistance. I won't go further of this because, for example, from 1900 to 2050, that's still almost at 10%, so it's quite a big move. That's it. This is a way to analyze. I explained you that the main idea that at least me I'm using is not to see gold to 3,000, 4,000 like some analysts and CBC are telling soon. I will be more comfortable with some with gold digesting this previous rally, and without going too far away, I would not even scared if I will see, we will see gold even 7,000 or lower during next several months. Basically, that's it. I hope I had been quite clear, not too much confusion. So I'm open to any question that you want to make. Already spoke 25 minutes. So just let me know. Okay, here I have a question. Are correlations still working when markets are flooded with cheap money as nowadays? What happens now to gold? Will it go up again? Okay, this question has been made some minutes ago. Once again, to be clear, I don't think that it will immediately go up as a rocket. The future could be still a good one, but I suppose there will be some consolidation. There will be some consolidation, and this is not a problem anyhow for traders. One can still have a lot of opportunity in any situation. I wanted, as we are here waiting for other questions, I wanted to show you the overall situation of metals. You see that there's several metals that have been doing good lately. Let's look to the last year. Right. So we see silver. Silver is another precious metal and has been underperforming in the past gold a lot, and has been catching up during last months. They keep in your mind that silver is absolutely more much more volatile than gold. When gold moves 1%, silver moves 3%. Keep it in mind, think about your risk aversion. Okay. What we can see here is also another thing, but also other more industrial metals are doing well. Palladium, copper, doing quite well, no, sincerely well. Palladium is doing even better than gold during last year, and same results during this year. Why? Because mainly because apparently the resurgence of the economy of China is going really well. Industry is going well in China, so there's a lot of demand for metals, also productive metals, because probably gold is the less used in industrial usage metal. Silver is used, copper is the king, platinum and palladium used for many uses. But when money flow to gold, gold is a storage of value. Gold was the metal to which our currency were linked till 1971, till the gold standard has been removed. At that point, till 1971, all the central banks could only have as much money in circulation as gold as reserves. That has changed totally our economies during the last 40 years. That's also why gold is so important. Of course, in 30 minutes, we cannot touch everything. There's a relationship with balance sheet of central banks, with money supply, with loss of money. But it's not the purpose of this webinar. Okay, I don't know if you want to make any further questions. I'm not receiving anyone really right now. Okay. If not, I would say that this is the main idea. Trading is about levels, so find your levels, understand your time frame, find your pattern, your setup for entering a trade or not. You can have eventually a different idea from the one we have about gold. You can look at dollar very closely. If the dollar goes up, I will absolutely sell gold. It's still working. But yes, it's good to have an overall long-term idea. Ours is that it's very interesting relationship with real rates. It's totally inverse. The reason we already told you. Madame and Monsieur, I hope it was somehow interesting. The next days we will speak through WhatsApp, through Telegram. If you have any suggestion, we will really appreciate it to know where we can improve. And that's it. Thank you very much for watching this webinar from Libertex. Have a good evening. Bye-bye.